You wake up tomorrow morning, check the news. Manhattan is quieter, not empty, just different. The hedge fund offices in Midtown? Half vacant. The penthouses overlooking Central Park? Listing prices dropped 30%, still no buyers. The Michelin-starred restaurants? Closed on Tuesdays now because there aren't enough customers to justify staying open. This isn't science fiction. This is the early warning system flashing red. In 2025 alone, 142,000 millionaires packed their bags and left. Not for vacation, forever. By 2026, that number hit 165,000. We're talking about $91.8 billion in combined wealth just gone, relocated, repositioned. And here's what should keep you up at night. These people don't move randomly. They move when they see something coming. Let me show you something that once you see it, you can't unsee it. First, let's establish what we're actually looking at. This isn't your typical rich person buys a vacation home in Monaco story. This is the largest peacetime wealth migration in recorded history. 142,000 millionaires in 2025. That's more than double the migration levels from 2016. These aren't just wealthy individuals. They're taking their networks, their advisors, their family offices, their institutional infrastructure with them. The United Kingdom lost 16,500 millionaires in 2025 alone. That's a 74% increase from 2024. That single-year exodus equals the total number who left in the 6 years following Brexit. Treasury data shows $91.8 billion in combined wealth walked out the door. China continued hemorrhaging wealth, somewhere between 7,800 and 15,200 millionaires, depending on which data source you trust. Russia? The Russian central bank admitted to net private capital outflows exceeding $160 billion in 2024. That's 8% of Russia's entire GDP, and everyone who understands Russian accounting knows that number is conservative. Now here's where it gets interesting. These aren't people fleeing war zones. The UK has rule of law, China has economic growth. But the money's leaving anyway. Why? Because ultra-wealthy individuals and their advisory teams don't wait for CNN to tell them there's a crisis. They position for the crisis while you're still being told everything is fine. This has happened before. Watch. 1780. The Dutch East India Company controlled 50% of global trade. The Dutch guilder was the world's reserve currency. Amsterdam was the financial capital of the planet. Dutch merchants were so confident they bought tulip bulbs for more than the average worker made in a decade. By 1799, the Dutch East India Company was bankrupt. The guilder collapsed, Amsterdam lost its status, and the wealth that saw it coming already relocated to London. Same pattern, different century. The British Empire at its peak, the pound sterling backed by gold, accepted everywhere. London, the uncontested hub of global finance. Then came overextension, military spending across 6 continents, currency debasement to service debt, resource grabs in the colonies when the math stopped working. And before the textbooks recorded the decline of the British Empire, the smart money had already moved to New York. The pattern is always the same. Stage 1, prosperity through innovation or conquest. Stage 2, currency becomes global reserve standard. Stage 3, overextension, military, financial, both. Stage 4, desperate resource grabs and coercion. Stage 5, currency debasement to service unpayable debt. Stage 6, loss of reserve currency status. Stage 7, collapse or forced reset. The ultra-wealthy don't need to predict when the collapse happens. They just need to recognize which stage you're in, and then they move. So which stage are we in right now? Let me paint the landscape these people are seeing. The World Economic Forum's 2026 Global Risks Report shows that 59% of respondents view the near-term outlook as either turbulent or stormy. Only 1% anticipate calm conditions. These aren't activists with cardboard signs. These are central bankers, sovereign wealth fund managers, and the people who move billions before breakfast. Geoeconomic confrontation ranks as the top risk most likely to trigger a material global crisis in 2026. That's not, maybe we should worry about trade tensions. That's, the system is fracturing in real time. Russia-Ukraine, 4 years, no resolution. North Korea ramping up. Taiwan, where 90% of the world's advanced semiconductors are manufactured, sitting in the crosshairs of an increasingly aggressive China. US trade wars expanding, not contracting. For people whose wealth derives from global supply chains, cross-border investments, and international market access, this isn't background noise. This is the sound of the ice cracking beneath your feet. Now look at Russia specifically, because Russia is the blueprint for what capital flight looks like when elites recognize the game is rigged against them. $160 billion in net private outflows in 2024. The Kremlin isn't just watching, it's blocking people from leaving. The industrialist Konstantin Stukov, CEO of a metallurgy conglomerate, was physically prevented from boarding his private jet to Dubai. No charges, no explanation, just, you're not leaving. When governments stop people from moving their own money, it's not because everything is fine. It's because they know if the exit door stays open, everyone runs for it. And here's the thing about capital flight that most people miss. Capital doesn't flee because it's disloyal. It flees because the rules are changing faster than compliance is possible. Now, geopolitics is the fire, but tax policy? That's the gasoline. The United Kingdom abolished non-domicile tax status in April 2025. For decades, if you were wealthy and met certain criteria, you could shelter foreign income from UK taxation. Approximately 74,000 people use this structure. The government projected billions in new tax revenue. What actually happened? Over 10,000 millionaires left in 2024 alone, a 157% year-over-year increase, and they left before the policy even took effect. That's the key insight. Ultra-wealthy individuals don't wait for the tax increase to pass. They don't wait for the policy to be implemented. They move when the headline breaks, because they understand that by the time the policy is enacted, it's too late to relocate efficiently. France, Germany, Spain, same story. German millionaires increased inquiries for alternative residence and citizenship by 114% between 2023 and 2024. These aren't random spikes. This is coordinated portfolio optimization across national jurisdictions. Here's how the wealthy think about this. They don't have a home country. They have a portfolio of jurisdictions, each offering different advantages. Low taxes here, strong rule of law there, geographic diversification everywhere. And when one jurisdiction starts looking less attractive, whether through tax hikes, regulatory uncertainty, or geopolitical risk, they don't protest. They don't vote harder. They just leave. So if billionaires are fleeing the UK, China, and Russia, where are they going? The United Arab Emirates. 9,800 millionaires in 2025, projected to maintain that through 2026. This isn't a trend. This is a structural reorientation of global capital. Zero personal income tax, zero capital gains tax, zero inheritance tax. The Dubai Golden Visa program offers 10-year renewable residency for a $545,000 real estate investment. You don't even have to live there full-time. You just need to establish tax residency. But it's not just about taxes. The Dubai International Financial Centre now hosts 120 family offices managing approximately $1.2 trillion in assets. Millennium Management, one of the world's most sophisticated hedge funds, employs more than 120 professionals across 25 trading pods in Dubai. This isn't wealth tourism. This is permanent institutional relocation. Singapore pulled in 3,500 millionaires. Zero capital gains tax, no inheritance tax, rule of law you can set your watch to, geographic positioning that lets traders cover European and Asian markets from a single time zone. The United States, despite everything, attracted 7,500 millionaires. Why? Because for all its problems, the US remains the center of technological innovation. AI minted over 50 new billionaires in 2025 alone. If you're building the next generation of wealth, you build it where the infrastructure, talent, and capital converge. Right now, that's still America. Italy brought in 3,600. Portugal, 1,400. Both deployed golden visa programs offering European residency through real estate investment. Montenegro, a Balkan nation of 620,000 people, saw its millionaire population grow 124% over the last decade. Fastest growing millionaire hub on the planet. And then there's Saudi Arabia. 2,400 millionaires in 2025. That's a 700% surge. Vision 2030 isn't a slogan. It's a coordinated campaign to diversify beyond oil by attracting the human and financial capital necessary to build a post-oil economy. Here's the pattern. The places winning the wealth migration race all combine safety, stability, robust legal frameworks, and sophisticated financial infrastructure. They're not just offering low taxes, they're offering certainty. And in an uncertain world, certainty is the most valuable commodity. Now we arrive at the question that matters. Do billionaires know something before the rest of us do? The honest answer is, sort of. They don't have crystal balls. They can't predict the exact day a market crashes or a currency collapses. But what they do have is something more valuable: perpetual crisis positioning. Think about it. Warren Buffett famously built a $40 billion cash position before the 2008 financial crisis. People called it genius. But Buffett himself said he didn't know when the crisis would hit. He just knew that when credit systems malfunction, liquidity becomes supremely valuable and distressed assets trade at extreme discounts. That's not prophecy. That's permanent defensive positioning. Russian capital started fleeing to the UAE and Central Asia throughout 2021 and early 2022, months before the Ukraine invasion. UK millionaires accelerated departures in 2024, anticipating non-dom tax reform that didn't take effect until April 2025. European wealth migration spiked in response to perceived geopolitical deterioration before any actual military escalation. The ultra-wealthy don't wait for the crisis to announce itself. They maintain standing infrastructure, offshore accounts, alternative residences, international legal structures, diversified portfolios. When something smells wrong, they don't build a lifeboat. They get in the one they built years ago. So do they predict crises? No. But do they recognize emerging risks earlier than conventional economic indicators capture them? Absolutely. Because while you're watching the news, they're watching their advisors. And their advisors are watching capital flows, regulatory trends, geopolitical shifts, and debt sustainability models. By the time the crisis makes headlines, the smart money has already repositioned. You're always the last to know. And that's not an accident. Okay, so they're moving. But what are they doing with the money once they get there? Let's talk alternative assets, because this is where the strategy gets really interesting. Fine art. Global ultra-high net worth allocation to art and collectibles exceeds $2 trillion. Why? Because art is a store of value resistant to currency devaluation, immune to political appropriation in most jurisdictions, and historically appreciates during periods of monetary instability. Design and decorative art sales increased 20% in the first half of 2025. But here's the sophisticated move. Rather than selling art into uncertain markets and triggering capital gains taxes, wealthy collectors are securing loans collateralized against appraised collection values. Bank of America's art loan commitments grew 14% year over year in early 2025. Translation: they keep the assets, they access the liquidity, they avoid the tax event, and when the crisis hits, they have dry powder to deploy into distressed opportunities. Cryptocurrency. Bitcoin trading between $130,000 and $200,000 throughout 2026, according to expert forecasts. Russian oligarchs and Chinese entrepreneurs have increasingly allocated portions of portfolios to crypto, specifically to circumvent capital controls. Because when your government can freeze your bank account with a phone call, decentralized assets start looking really attractive. Stablecoins, cryptocurrency pegged to fiat currencies, have gained institutional adoption as cross-border transfer mechanisms. The Genius Act passed in July 2025 provided regulatory clarity. Now, ultra-wealthy individuals contemplating jurisdictional transitions can move millions across borders in seconds at minimal cost, completely outside traditional banking infrastructure. Rare earth metals, critical to AI infrastructure, clean energy tech, semiconductor production. China dominates global extraction and processing, making supply risk a geopolitical weapon. Ultra-wealthy investors are positioning in rare earth mining equity, ETFs, and direct participation specifically because technological demand is structural and supply is geopolitically constrained. The theme: hard assets, decentralized stores of value, anything governments can't print, freeze, or confiscate easily. Now let's talk about what happens to the places they're leaving, because this isn't just about billionaires getting richer. This is about entire cities collapsing when the tax base walks out the door. The top 1% of earners contribute approximately 40% of New York City's income tax revenue. Let that sink in. If those people leave, the city doesn't just lose their tax payments, it loses the entire economic ecosystem surrounding them. Every high-earning financial executive supports 4 to 6 additional service sector jobs: personal assistants, drivers, household staff, security. When the executive relocates to Dubai, all those jobs vanish. The multiplier effect cascades. Luxury retailers lose customers and close. Real estate values collapse. Tax revenue drops. Municipal services degrade. Crime and quality of life deterioration accelerate, which triggers more departures. It's a doom loop. For every Wall Street job that leaves New York City, the city loses approximately $1.2 million in direct and indirect annual economic activity, $180,000 in combined city and state tax revenue, and 3.2 additional jobs across supporting industries. The UK government expected billions in new tax revenue from abolishing non-dom status. What they got instead was 16,500 millionaires leaving and taking $91.8 billion with them. You can't tax people who aren't there. And here's the nightmare scenario policymakers won't say out loud. Once the exodus starts, it becomes self-reinforcing. Because wealthy people cluster. They want to live near other wealthy people. They want the schools their kids attend to be well-funded. They want the hospitals to have the best doctors. They want low crime. When the first wave leaves, the second wave sees the deterioration and decides, why am I staying? Then the third wave, then the fourth. At some point, you're not losing a tax base. You're losing the entire city. So where does that leave us heading into 2026? The signals are mixed, and that's what makes this so dangerous. The Conference Board's leading economic index declined 0.3% in September 2025. It's falling faster now than in the prior 6-month period. That suggests slowing economic activity. The SARM rule recession indicator, measuring unemployment rate increases, stood at 0.35 percentage points in December 2025. It triggers at 0.5. We're halfway to a recession signal. If unemployment trends persist, we hit that threshold in February or March 2026. But corporate earnings? S&P 500 earnings are forecast to expand 14% in 2026. How do you reconcile slowing economic growth with expanding corporate profits? You don't. Unless corporations are maintaining profitability by squeezing labor, cutting costs, and benefiting from the fact that their competitors are dying faster than they are. Then there's commercial real estate. Approximately $900 billion to $1 trillion in commercial debt matures in 2026. Historical average refinancing volume, $200 to $300 billion annually. Developers who borrowed at 0 to 2% now need to refinance at 6 to 7%. The math doesn't work. Buildings that were profitable at 2% interest are worthless at 7%. When those defaults cascade, banks get stuck with vacant properties, credit markets seize, and if you're a billionaire heavily invested in commercial real estate or REITs, you're watching this and thinking, I should be somewhere else when this breaks. Alright, you're not a billionaire. You can't buy a golden visa tomorrow. You don't have a family office in Dubai. So what do you actually do with this information? First, geographic diversification in your portfolio. You don't need to move to Singapore. You just need international equity exposure. A simple allocation of 20 to 30% to non-US companies, whether developed or emerging markets, reduces your dependency on any single national economy. If the US faces a crisis, your international holdings provide ballast. Second, cash reserves. Billionaires maintain billions in dry powder to capitalize on panic-driven fire sales. You maintain 6 to 12 months of living expenses in liquid reserves. This enables you to weather job loss, medical emergencies, or market dislocations without forced asset sales into depressed prices. It costs nothing. It's the highest leverage wealth preservation strategy available. Third, understand your portfolio's geopolitical exposure. Do you own companies with supply chains dependent on Taiwan, Eastern Europe, the Middle East? If geopolitical tensions escalate, those holdings carry asymmetric risk. Diversify across sectors and geographies. Don't concentrate in single choke points. Fourth, tax loss harvesting. During downturns, volatile positions produce losses. Recognize those losses strategically to offset gains elsewhere in your portfolio. Reduce tax liability while maintaining desired allocations. This isn't exotic, it's mechanical, and increasingly, automated platforms do it for you. Fifth, start researching investment migration pathways aligned with your capacity. You don't need $10 million. Portugal, Italy and others offer residency programs starting around $300,000 to $500,000 through real estate investment. That's not billionaire money, that's upper middle class money. And it buys you optionality, the ability to establish alternative residency if conditions in your home country deteriorate. The principle is simple. Don't wait for the crisis to build the lifeboat. So here's what we know. 142,000 millionaires relocated in 2025, 165,000 in 2026, $91.8 billion left the UK, $160 billion fled Russia. The UAE consolidated 9,800 new millionaires as institutional capital established permanent operations. These aren't random movements, they're distributed elite recognition of emerging systemic vulnerabilities, geopolitical deterioration, regulatory unpredictability, economic prospects shifting from traditional power centres to ascendant alternative hubs. Do billionaires possess prophetic foresight? No. But do they maintain perpetual crisis positioning, superior advisory networks, and the willingness to act on uncomfortable information before conventional indicators scream emergency? Absolutely. The ultra-wealthy don't flee because they know the future. They flee because they understand the present better than you do. And by the time you see the crisis on the news, the smart money has already moved. So the question isn't whether a crisis is coming. The question is, when the people with the most to lose start running, why are you still standing still? If this connected dots you hadn't seen before, share it. Because most people don't know the game is rigged until they've already lost. Subscribe if you want to keep